All right, everything looking good. Should be live. Let's go ahead and get this stream started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So obviously, title of the stream today, oil is in for a crude awakening. And as we have been discussing, I suspect, and the charts are confirming, all but inevitably, oil has reached a top. Is this a macro top? Is this it? Is this the next high before we go back into an oil bear market? I don't necessarily think that's the case. But let's go ahead and jump into oil, and we can take a look from there. So let's see what this chart's telling us. So just starting here, taking a look on the daily. The last specific time we had talked about oil being in a value area was when it came down and touched our 200 exponential moving average, tagged it perfectly, was able to get back on top of the 8 and 21, and then we saw a nice little continuation to the upside from what amounted to that cross was at $68 roughly, and then we peaked out here at just about $86. So this is the US oil WTI crude chart. So then obviously we started to see some weakness. We came down here and found some support on our little green support line here, came back up and essentially put in what amounted to a double top. We saw some clear divergence on the TJD TDMACD, and now here we have seen that the slope line has now rolled over. We've had only red histograms since then. We had a hard sell signal coming out of the bullish control zone before that on the jewel thief, and now obviously our stochastics are trending down. Now we have confirmed the 821 cross back to the downside. And, you know, obviously we had mentioned how the Fibonacci from the bottom down here off the 200 exponential to the top of this little move up right here. Once we came down and tagged the 236, we confirmed that we could start Fibonacciing this move right here that we had confirmed a potential top was in. So all those things together with the double top and now taking out that previous low on today's daily close. Now confirms basically that we have a high, we have a low, we have a same high or, double top basically, and now we have a lower low. So we're confirming that we are now entering into at least a short-term downtrend. Now this is on the daily, and we still have plenty of room to run. We'll see once this red slope line flips over on the TJD TDMACD, we'll oftentimes get a more powerful move down, an attempt to push back up, and then another lower high, and then see some continuation. So I'm expecting something similar to that. If we look back at the previous one, we basically sell off, come back up, put in a lower high, and then from that lower high, we basically confirm the red slope line flips. We see a pretty violent sell-off, attempt to come back up, and then we put in a lower low as well. So, it's pretty typical. These markets are obviously determined by, big money market makers, bots, algorithms, etc. So, they trade pretty textbook. There's not a lot of anomalies. Now, obviously, anything could happen here, but I'm expecting a similar move to take place. So just kind of looking at some of our potential targets, our first short-term target is going to be that previous high right here, which lines up almost perfectly with the 382. So I do expect oil there probably in the next couple of days, $75.32. But in all reality, a retest of the 618 and the 200 exponential and simple is more likely going to happen than not. So depending on when we get there and how long this takes, obviously the 200 exponential and simple are going to keep creeping up as we go. But I would expect somewhere around that 69, basically around $70 to $71 as a target there. Now I would expect obviously stair step along the way, potentially even a push all the way back up to retest our support as resistance once we break down from this yellow support line here. But in all actuality, let's zoom out and go to our next chart or our next time frame, and we can get a better idea of what we're expecting here. So obviously, because of that crazy wick back then, this chart can get a little crazy, but let's go ahead and get that off. Okay, great. So obviously from our low back here, that pandemic low, April 2020, we had obviously a pretty big sell-off there, essentially when everything was shut down and there was all those issues. I consider that to be obviously an anomaly, but oil all but went to zero essentially at that point in time. That's obviously not sustainable. We had a pretty violent recovery, and on the weekly, we actually reclaimed the 200 exponential and simple right around the 4th of January 2021. So the beginning of January 2021, we were able to break above the 200 exponential and simple. We flipped the slope lines back over blue on those, and we confirmed that we're entering back into a bull market. We recently crossed the 200 exponential above the 200 simple here, confirming that we were actually in a nice trending move to the upside. And then we'll see, obviously, we're back inside the bullish control zone. We had multiple green histograms and reclaimed the blue slope line. But now what we're seeing and what we've been expecting, or should I say waiting for, has finally confirmed. So let's take a look at that, and we can kind of go from there. Matter of fact, yeah, let's go ahead and so we can clearly illustrate what I'm looking at right here. So we're going to pay attention to 3 key points that we have on this chart. And I think that's going to give us a pretty clear idea what we're paying attention to. So obviously this is the weekly chart. Just going to illustrate these really quickly, and then we can go through and take a closer look. So just give me one moment, as I did not update these on this current chart here. There we go. Okay, so what we're paying attention to here is, obviously, we have a high, that first little peak there. Then we have another high, which is higher than the previous one. And then, of course, we have a third high. So we have 3 highs, each one higher than the previous. So, a high, a higher high, a higher high than that. So now we have essentially confirmed that we have put in this third high right here, and we're coming back down. Now, is it possible we come back up and put in a 4th high? It 100% is possible, and I would not rule that out. But what I'm paying attention to now is that 1, we got the 821 cross on the daily to the downside. 2, we're clearly peaking, which what I pay attention to for like a temporary peak based on like just the candlestick or the pattern itself is, once we start to take out like the previous candle before it, and we start taking them out with red candles, which obviously at this point in time we've wiped out like the previous like 2 big green candles to the upside with this like series of red candles. So now if we go back down to our indicator oscillators, we will notice the divergence taking place. So here we have the first high, which is obviously the stochastics are up higher, highest. And then after that, we have a lower high than the previous high on the blue stochastic here. So that is giving us a drive of bearish divergence as price action has made a higher high while the indicator oscillator has made a lower high. So we've used less energy to reach a higher price, which tells us that this is unsustainable, the divergence between the price action and the indicator or oscillator, depending what we're looking at. And then now here, this is our third drive on the weekly. And again, we have put in a lower high. So we now have 3 drives of bearish divergence on our stochastics. And that's the Jewel Thief. And then obviously, if we look down here at the TJD TDMACD, we can see a similar signature taking place as well. So here we have our first drive. We have a lower drive for our second drive. We have a third lower drive here as well. So once again, 3 drives of bearish divergence as price action has put in a higher high on each of the successive highs. And our histogram has put in a series of lower highs. And, we obviously can determine the peak by looking at it and seeing clearly, it forms a peak or forms a high. But then we also have the histogram transitioning to red in each of these cases as well. So obviously once the transition goes to red and we see more than one of those histograms in a row, I consider that based on just this indicator right here to be essentially like a peak. So at this point in time, we have on the weekly time frame, triple bearish divergence on oil price action versus our Jewel Thief and our MACD. Obviously these are 2 different versions of them, but essentially that's what we're looking at. So what do we expect to happen after that triple bearish divergence plays out? Well, we would expect a, moderate to large correction. So based on what we're looking at here, if we just take off our drawing tools and just try to get an idea as to what we would expect for that correction, we know that on the weekly, once we crossed above the 200 exponential and simple back here, we were confirming once the slope flipped back over to blue on both those that we had entered into a weekly or longer term bull market based on obviously my own measures. And then obviously our indicator oscillators were telling us the same thing. As we were getting a hard buy, we were above the slope line and the slope line was blue. So now that we've put in triple bearish divergence, I am macro still bullish on oil on the weekly time frame, but I do expect us to get a reversion to the mean or something close to it. So we'll notice after the first divergence point was put in here, we got a powerful sell-off back down below the 8 and 21, but we're able to reclaim that area and continue to the upside. I do not think this will be the case this time. I think this time we'll get the full reversion to the mean, which essentially will be a retest of the 200 exponential and simple. So depending when we get there, I would expect price action to reach roughly $57 to $60, depending on how long that takes. And then obviously once we get down to that level, we will have crossed the 8 and 21 to the downside as well. So we may see further downward or sideways price action. Now what we will pay attention to when we reach this point though is, does this support hold? Because if this support holds and when we get down to it, we stay above it or continue to, oscillate and then eventually start to move back to the upside, that will confirm that oil has in fact broken above its 200 exponential and simple moving average. It has retested them as support, and then we would expect continuation. So that's essentially an SR flip. Anytime we're underneath the 200 exponential and simple and they are red, or in this case pink, we would expect them to act as resistance and potentially a rejection and then continuation to the downside. But in this case, we have broken through them, and now this would be a retest of them, which if we can hold them as support, we would expect continuation to the upside. So in this case, obviously we have been oscillating around this range. We had this attempt right here back in, this was a cross above in 2017. We'll notice we flipped the 200 exponential blue, and then right around the end of that time, we flipped the 200 simple blue as well. And then once again, we get the reversion to the mean. We come down to it, but we're not able to hold it as support. So this is the retest, and then it fails. We then put in a lower high, and then we sell down to it, consolidate for some amount of time, attempt to push up, and then obviously this is the beginning of January 2020. We have basically a black swan event, turning off the entire economy. Obviously oil, you would expect to take a massive hit, but realistically everything did, at which point in time we see that capitulation event. So now this is the attempt of us to reclaim those levels. So now when we come down to here, is it possible that we fail and then continue and go back down? It is definitely possible. But at this point in time, because we have taken out this previous high right here, because we have flipped the 200 exponential and simple back to the upside, because the 200 simple is on top of the 200 exponential, I would expect this area to hold. So we'll have to wait and see. But in the meantime, I'm bearish on oil for a retest of roughly the high 50s or low 60s. And I would say that's with great conviction. So now if we just switch over to the longer time frame, let's take a look at what we're looking at here. And this is where we can really get an idea as to what is going on. So let me just zoom this out. Okay, so we'll see that basically, this chart goes way back. So we're talking about like 1980s essentially back here. So we obviously had a consolidation period, and then we resumed the uptrend. We had a very similar move to what I was just talking about on the weekly here on the monthly. So when we crossed above the 200 exponential, flipped the slope line over blue, above the 200 simple, flipped the slope line over blue. We came back down, had a reversion to the mean, retested that as support. It held as support, and then we went into a macro bull run. And that was essentially a retest back in 2002, and then oil peaked out in 2008. So we had a 6-year bull market in oil where the price went from $20 to $147. So obviously, we're talking about a 600% gain in oil, a massive, massive bull run. At which point in time we came down once again, had the reversion to the mean or the retest of the 200 exponential and simple moving average. We were able to hold them as support, came up and put in a lower high, consolidated for a period of time, and then broke down to a lower low. And then we went into a macro downtrend. So we have a high here, we have a lower high, we have a lower high, we have a low here, we have a lower low, we have a lower low. And now here we have done something for the first time since that trend took place with the top in 2008, which obviously was, the global financial crisis or, the mortgage bust. But essentially at that point in time, 2008 top, we now have taken out this third lower high right here. So if you just imagine, essentially a red resistance line right here, that is basically the top of those peaks. And now here we have broken above that peak. We came down and retested it as support and saw that continuation happening. So we're expecting potential move to the upside now. But what is likely to happen is, now that we've reclaimed the 200 exponential, we've reclaimed the 200 simple, and we have them both flipped over blue and to the upside, the 8 and 21 have crossed to the upside. This looks bullish on the macro monthly chart, especially since we took out this previous high right here. So that's where our next target comes in, which is going to be the high before that, which is roughly 113. So while long term, I think we get up to $113 to $115 and we retest this level as resistance, and then potentially after that, retest the highs and possibly all-time highs. I don't think that at this point in time, we're going to see that continuation to the upside. So now it is still possible on the monthly that we rally right here, we reclaim, some of this lost price action, and, possibly can turn this trend around, move up, and potentially even put in a fourth tribe of bearish divergence or invalidate that divergence. But I think that's very unlikely. What we're seeing here is on the same indicator oscillators, we're seeing the stochastics are starting to roll over on the monthly. We're still very much inside of the bullish control zone, but we're at extremely high levels, like 94. If we look back at our previous top here, that was at 92.40. We look back at the top before that, that was at 89. And if we look back at the top before that, that was at 90. And then if we just zoom out and look what those tops correspond with, that was the macro top all-time high. This was our lower high top right here. This was the third top right here as well. So we see that each of these macro tops corresponds with the levels that we're at right here. So if this was our, all-time high, this was our lower high right here, and this was our lower high right here as well. The fact that we're above those 3 points right now, we're at a higher high, but we're at a lower high on price action, tells us that, essentially this trend once again is unsustainable. Now it's not printing divergence on the monthly between these 2 points, but it is telling us that we're at the levels where we would expect a macro sell-off to take place. And the previous macro sell-offs were from, essentially, these were big sell-offs. While I'm not necessarily expecting that to happen, this was a 73% sell-off in oil from the all-time high, from our, next point to the low. That was a 77% sell-off in oil. And then from this previous high to, let's just go down to like 18, because that was our closes. Obviously, it wicked down like ridiculously low, but that was a 75% as well. So while I'm not necessarily expecting a 75% sell-off or something close to that, I am expecting this to be at least a temporary macro high. So now what I want to see happen, if you want to stay bullish on oil or you are bullish on oil, what you want to see happen is this to sell off and then find some kind of support right around like 60, hold the 200 exponential and simple on the monthly as support, or possibly even oscillate around here for a bit in the high 50s or low 60s, and then put in another higher high so that we can possibly, we've obviously invalidated this high here. We're obviously at a high level, but this could essentially correspond with a sell-off back down, finding support around the 80 level here, and then continuing back up to either a lower high or higher high, either way. But we want something like this where we essentially get like a double top scenario, something like this where we get that double top scenario, or even potentially something like this where we roll over and then we get another push back up, essentially just continuation. But that is what I'm expecting. That is what I want to see if bullish is going, or if oil is going to stay bullish as well. So expect, in my opinion, something around a high 50 to low $60 a barrel crude in the near future. So that's my outlook on it. That's what I'm paying attention to. Right now we have still all gradient histograms on the monthly. We're well above the blue slope line, the zero line, and trending to the upside. We are obviously still inside of the bullish control zone, but starting to roll over. So I think this will come back down and bounce the pink Stoch right here, and also like that 80 level somewhere around there, and then we'll see another push back up. But on the weekly, we do have that triple bearish divergence, so it would not surprise me whatsoever to see a nice hearty pullback on oil, which would, from the top, just to retest the 200 exponential, is a 27%. Obviously, everyone has piled into the oil trade. It has had quite a bit of momentum, and now everyone's extremely bullish on oil, at least short to midterm, especially going into the winter months. So it would not surprise me for this trade to be exhausted and, see that cool down. Now, fundamentally, you could argue, well, oil's not going to go down because, whatever reasons. We're going to need more oil because winter months, whatever your argument is, more oil is not going to come online because of OPEC, et cetera, et cetera. But the fact of the matter is that this is not drawn, this price action in oil, this pushback up to the upside is not being propelled to the upside by supply and demand fundamentals. like the excess, or should I say the deficit in supply to demand is very small at this point in time. It's very little compared to the overall supply. So more realistically than not, this is based on, speculation. And many people, including myself, obviously speculated on the oil play when it was clearly, well undervalued when it essentially hit zero, negative, or in this case, just by closes like 19. So now, what do you care? You're not trading oil. So yeah, okay, maybe my gas goes down a couple dollars. How does that affect everything else? That's the real question. And it's an important thing to pay attention to because oil does affect quite a few things, not just the actual price of like oil companies or gasoline. Obviously gasoline is clearly going to be affected by it. So if oil starts to sell off, gas prices will subside a little bit, which will obviously be nice, especially going into the holidays, travel season. But we may even see a lag with those, as the actual futures, or like oil trading may not matter in time. Thanksgiving's right around the corner. Christmas, obviously, like, just over a month and a half away. So maybe prices on actual gas at the pump are not even going to see the effects of like lowering oil prices. But potentially, things like natural gas are going to be directly affected. Obviously, the United States is not seeing the explosion in natural gas prices the same way that, Europe and England are currently. So it's not going to have as big of an effect on us, but it should alleviate some of that pressure for them in time. And then obviously fertilizers. Natural gas is obviously a key input in the production of fertilizer. So obviously fertilizer prices dropping is going to help out, a lot of consumable commodities like wheat and corn and, animals, obviously, as they are fed with, wheat and corn. So we should see like some of the alleviation on pressure with some of them as well. So again, this is going to fight a lot of the inflation argument or like the, CPI increases that we're seeing. So again, it's going to take some time to work out, but some temporary like weakness in oil or a temporary like pullback consolidation in oil should alleviate some of the excess prices, should obviously like further, like the agenda of the Fed and those that are calling for, the inflation to subside, at least to some degree. But overall, we can expect gas prices, natural gas, fertilizers, agriculture, all that stuff to slowly subside like the overall prices. Now, what is that going to do for some of the other commodities? Well, or stock prices? Well, obviously, things like gold, silver, going to see a decrease in production costs because they are, oil intensive in the sense that, obviously you have a bunch of big machinery, digging out rocks from the ground. So a decrease in the cost of production is going to increase profitability. So while we may not see a direct effect on the price of gold and silver and some of the other like, metals, commodities in the same way, the actual like mining companies or producers of those will obviously see, a reduction in costs, therefore, become more profitable. And most of their balance sheets are already in nice shape. They're also benefiting from our commodity run-up that has taken place over the last, year plus. So that could actually look very good for a lot of like these mining and, production companies. So that's definitely something I'm paying attention to for like the macro shift, as one could argue that while the miners had a nice run-up leading into all this, and many of the commodities did as well, that, the profitability and, arguably they're undervalued. So that's what I'm paying attention to. And then obviously, I talk about it all the time, but the way I look at, oil is it's the cost of production, the cost of doing business, the same way that interest rates are the cost of money, oil is the cost of production. So while we won't see the same reduction in costs or, reversion to like more of a reasonable level in costs for like factories and manufacturing and stuff like that, they should also alleviate some of the pressure on those producers as well, just for like any type of manufacturing. And then finally, we have like our transportation sector. Obviously, if you are a jet company, and oil goes down in price, jet fuel therefore would see some alleviation, or, depending on what other transportation sector, if you're essentially like, let's say for instance, like UPS or FedEx or something like that, obviously the input price going down. And then we also have things like, Uber and Lyft and, companies that are heavily reliant on oil because that's one of their like predominant, like larger costs of doing business. So we're looking for like those sectors and how they're going to be affected. And we would expect that to essentially translate into, if the oil prices continue to go down as I'm expecting, we should see like consumer discretionary do well as well. So now again, we'll see this is going to be a lagging effect. We could always continue to rally to the upside, but this is going to predominantly in some ways, it's going to affect many different sectors of the market, and I'm paying close attention to it. But more realistically than not, we really just want to see how this plays out on the weekly. But it's definitely worth paying attention to because, again, I'm not bearish on oil, but I do think it's very realistic that we're going to start to see a little bit of pressure and basically like a little walk down to the downside, which essentially will alleviate some of the inflation fears, etc. So do I expect those immediate effects? No, probably closer to like after Christmas or something like that, as it will take time to work its way through the system. Even if oil continues to go down towards like those high 50s or low 60s, I think that we're going to actually see that play out probably towards like the end of winter, beginning of spring, like early into next year. So, but again, remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. But definitely worth paying attention to. So that is oil, U.S. oil, WTI crude. So now let's take a look at the 10-year. So obviously TNX has been moving to the upside as we've been discussing. As of now, it looks like we're putting in a potential top, like a lower high. I do not think that will be the case. We have just crossed the 821 back to the upside. I think more likely than not, we're going to see continuation here. We got the hard buy signal coming out of the bearish control zone. We do have multiple green histograms, but the slope line did flip over blue right here on the TJD TDMACD. So when we come up to it, we're going to have to see, does this come up to it and get rejected? Because often when this flips over blue, before we get back up to it, when we're still under it and it flips back blue, typically that will end up in a rejection. So we'll have to see, that could very likely be bearish divergence developing as we potentially consolidate and then put in a new higher high right here with a lower high on our indicator oscillators, giving us some daily bearish divergence. So paying attention to that. Obviously, we have talked about this area quite a bit and how there's a bunch of what is now resistance potentially going to be flipping as support. So we have a lot of chop to work our way through around this level between like basically 1.5 and like roughly like 7.5. So it's going to take some time to chew our way through there. But, overall still looks decent for now, but potentially going to be seeing at least a short-term top as well. But now if we flip over to the weekly here, we can get a broader picture. And, obviously this is doing exactly what we've been discussing. We obviously topped or bottomed out down here, just above basically like 0.4%. Came all the way back up, obviously got bullish back here. Once we flip the blue slope line back over on the weekly, once we get the hard buy signal coming out of the bearish control zone, once we flip the 8 and 21 back to the upside around like 0.75, everybody was saying rates can't go up. They have to stay at 0. There's too much debt. And now here we went absolutely parabolic, ran into resistance exactly where we expected at the 200 exponential moving average, consolidated, sold back off. We'll see when we got the sell off here that we came down exactly to the 0.5 of the move from the high to the low, which is once again exactly what we're expecting. That was our high back here at 3.3. Here's our low here at 0.4. And then we came back and retraced exactly above the 618, but then back down to the 0.5, which is where we found support. So now what we're paying attention to is we have now created essentially a cup and handle pattern right here. So we have obviously a large rounding bottom here with resistance at our 200 exponential and simple moving average. And then we created a downward descending channel, which is part of the development of the handle itself and what you want to see for like a very nice technical cup and handle pattern. And then once you get the break of that descending channel, you would expect it to move back to the upside and then run once again into that resistance. So now we have a fully developed cup, we have a fully developed handle, and we are retesting the 200 exponential moving average. The longer we spend at this moving average right here, the more times we attempt to break through it, the more likely we are to break through. I discuss this all the time. Imagine there is a drywall wall in front of you and you're trying to get through it. You punch it the first time and you put a dent in it, and then you pull your hand back and you punch it again, and you might knock a couple pieces off, and then you pull your hand back a little less and punch it again, punch it again, punch it again. Eventually you're going to break through that drywall. So while it acts as resistance, the more times you punch that drywall, the more likely you are to break through it. So the immediate move we expect once we do consolidate here long enough and get that break is the retest of the 200 simple here in pink. So that would be around 1.8, and that would also be taking out this high. So then we have a low, we have a high, we have a higher low, we have a higher high, we have a higher low once again, and then potentially, if we take this level out right here, we would have a higher high once again. So again, that's going to tell us that we're likely to see continuation. Again, I would expect us to kind of chop around here between 1.9 and 1.6, between those moving averages, and then eventually burst through that back to the upside. So we have a very clear bottoming pattern. On the weekly, we have momentum in our favor, but now here we're seeing that same signature again where we have a bunch of green histograms above the zero line, but we are still below the blue slope line. So when we get back to that blue slope line, there's definitely some serious potential that could act as resistance. So we want to be careful that that doesn't see a rejection and sell off. We are inside of the bullish control zone, so we obviously have the stochastics in our favor, but we are at resistance. So again, the more time we spend just kind of chopping around here, the more likely we are to burst through it. If we see some kind of violent sell-off coming in right here, the main level we're paying attention to is that 1.45 level, the 0.5 that held from the previous sell-off. I'm sorry, this was the 0.5 level. The initial sell-off that we just had recently, like a couple days ago, but we're really paying attention to a close below that 1.22 level on the weekly, because if we take that out, it's going to look like a high, a low, a lower high, and then a lower low, and then we could potentially expect a breakdown all the way back down towards the bottom of the range, invalidation of a cup and handle bottoming pattern, and we would obviously have to reevaluate from there. But last but not least, let's take a look at the monthly chart here as well. Obviously still have half the month to go, but we can see, a very clear trend, obviously, in this. We broke down below the 200 exponential and simple back in 1986. We retested it as resistance. We got rejected there multiple times, and then eventually we broke down, retested it, broke down, retested it, broke down, retested it, broke down, barely got anything close to a retest, broke down, retested it here, and then that was our capitulation move going into the pandemic. So it would not be unrealistic to think that we have this cup and handle pattern play out, or something like an inverted head and shoulders, and then we get a move back up to test it again, at which point in time I would expect us basically to get rejected. It is possible we would break through it, but obviously we're in a very powerful downtrend that has lasted for literally since, arguably, depending when you're going to call this a downtrend, I would call it once the 200 simple moving average flips over bearish. That goes back to 1991. So at this point in time, we've got basically 30 years in a downtrend, or if you're looking at bonds, 30 years in an uptrend. So the most likely situation is that we continue in that downtrend, but a trend that has gone on for that long and something that has essentially reached zero rates, potentially we could see the flip of what was a 30-year bull market in bonds, or 30-year bear market in rates, back to the upside, or a technical breakout above that 3.0 level. I don't think it's very likely, but again, we're coming out of the bearish control zone. We have the hard buy signal. We're seeing the stochastics powerfully angled to the upside, seeing some temporary resistance at this, bullish control zone level. So again, it would not be unrealistic to see we consolidate here and then get a push back up. And then once again, we're seeing on the stochastics, on the histogram, a bunch of green in a row. We are above the zero line now, which is, step one and step two of our bullishness on this indicator. And now we're seeing the red slope. It's still angled to the downside, but it is rolling over to essentially be flat. So all we have to do is just consolidate anywhere above that slope line, and eventually it will flip over blue, and then we'll have momentum in our favor for rates to start rising. And we see that the previous time that happened, obviously this was in 2013. From then until the top of that little push up right there was, basically the better part of the year. But we see we essentially kept that blue slope line the entire way through. So, basically from, again, like January 2013 to when we topped right here was October of 2018. So we're talking about, like, including a retest of the lows, a sweep of the lows, we're talking about a 5-year, neutral to uptrend where we take out the previous high. So it's not unrealistic to think that if this flips over blue right here, we could essentially see a sweep back of the lows, or we could just see consolidation to put in a lower high, but that this process could take place over, a 5-year or so period. So, and again, we've seen that quite a few times, but every time we flip over that blue slope line, even though we are overall in a bear trend, we see that last for, somewhere around the better part of a year to 5 years. So, and obviously the rising yields will put extreme pressure on the stock market and other assets, including the housing market, etc. But specifically, we would expect like high valuation tech stocks or like non-profitable companies to suffer the most from that. So, but yeah, that's our 10-year. We can look at TLT really quick. Not much has changed right here. We're basically discussing this in the last video where we basically have broken down now below the 200 exponential. We still have a negative slope on the 200 simple. So again, I expect us to just kind of consolidate around this area. But depending what yields do, this is going to look more and more like a topping pattern right here. And I would expect this to break down and see at least temporary continuation. But the most important level to watch is, do we take out the high at like 152 or do we take out the low at like 141? As far as I'm concerned, until one of those things happens, we're just basically chopping around at this level. So, there was one more thing I wanted to, and on the macro, obviously we have the inverse pattern. This is potentially like a head and shoulders topping pattern. The longer we go sideways here, the less likely this is going to look like symmetrical, less likely it's going to play out. So, it's actually better if you're bullish on bonds, the longer we just kind of chop around here. I did want to turn on, we obviously have, this is what I've been paying attention to. We obviously have, this on log scale, but you can see we have a very clear support line here in blue that we have followed the whole way down. And then we have a very clear resistance line in red, that every time we've run into, we bumped our head. And then that corresponds directly with our 200 exponential moving averages. And then obviously we don't have a moving average on the downside right there, but we can see how that looks. And then if you don't like that I have these like rounded, lines here on the bottom specifically or whatever, you can actually do, how do we want to do this? We can turn off log scale and you can kind of ignore all the other drawing tools that are currently on there because I'm not going to delete them. But I know a lot of people don't like, log scale or prefer not to do what I'm doing there, etc. So you can essentially switch off log scale and get something like a little more like textbook if you prefer, as far as like a descending channel. So you can see here, let me make it a little darker because there is a lot going on here. So you can see here in green now, I basically have a descending channel that we're taking place on, and we found support here on the monthly multiple times at the bottom of the descending channel over and over again. And then again at the top, we're seeing resistance on the descending channel over and over again. And so our potential breakout of the inverted head and shoulders pattern here would give us the retest to the top of the descending channel, or potentially, and again, I say potentially because none of this is a sure thing, but potentially back towards the 200 exponential and simple, which is going to give us our, topping area. I expect somewhere around like 2.6 is where I'm expecting at least a short-term top. Now, in the event that we were to break out from this channel here, we would then expect to get, and again, very unlikely because we've been in a 30-year downtrend, we would do a measure move from the bottom of the channel to the top of the channel, and then we can take that measure move of the, width of the channel from the breakout level, and that's going to give us our potential target here, which is the 1.618 from our top back here in 2018 to our bottom back here in 2020 pre-pandemic crash, and then that's going to give us our Fibonacci extension target to the upside, which lines out perfectly with our downward descending channel target measure move to the upside, which gives us rates about 5%. And I know there's an argument, rates can never go to 5%. It's not possible. It would bankrupt the country, blah, 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 blah. The interest would be unserviceable. I mean, I literally don't care. Like, you can say as many things as you want, but I'm telling you what the technicals are saying and what could potentially happen. There's literally like countless things that could change in the world that would make it so servicing that debt would not be an issue, or possibly even like, crashing the economy would be the agenda of those in charge. So the fact of the matter is I'm looking at strictly the technicals when I'm like bringing up these charts. So that is our 10-year treasury yield and what I potentially expect to happen over time. So remember also, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. So please do your own research and trade responsibly. So today, going to keep this one relatively short and going to be doing like more short videos and potentially even just live stream like during the day, where I do like stocks during the day and you know, some of the other different things I've been talking about doing for the channel. But we're going to actually switch gears here, and we're going to take a look at our commodities. So we're going to look at gold and silver, obviously are doing some very important things right now. So just looking at the XAU chart, which is the gold spot chart, you know, we can pay attention to what is taking place and what we're potentially expecting to happen, or what could be happening here. You know, this basically like a shift in the markets. So it's a little clearer on silver, but essentially we have a potential left shoulder right here, a neckline, a head, neckline touch again, and then right shoulder. So we basically have an inverted head and shoulders potential pattern. And once we broke through the resistance, which, you know, essentially was the 200 exponential on simple, we would expect to potentially get the measured move of those back to the upside. So now obviously we have our targets in place right here. So there's quite a bit once again going on this chart. Let me turn off the moving averages so it's a little more clear. We can see we have a couple of different resistances on the top here in like pink and purple, drawn based on the time frames, depending if you're looking at daily, weekly, or monthly, going by like candle closes or most touch points. But we basically have our purple resistance, which is a little steeper to the downside, which we have broken through right here and then gotten our push up. And then we see our pink resistance here, which goes from all these different points right here, which is where we're at right now. So we have made it all the way back to that pink resistance. We'll see the same thing here on the bottom. We have the blue support and the green support, depending on what time frame you're on and going by candle closes, etc. We can see obviously how these resistance or support lines have corresponded on these push downs as well. So essentially, as far as I'm concerned right now, we are in a symmetrical triangle or a flag pattern, which typically after a move to the upside, this is a consolidation pattern followed by continuation. So this is a bullish pattern the majority of the time. So now what we're paying attention to is also the Fibonacci level from the top right here, the all-time high at just over 2,000, to our sell-off low right here at 1671. So we have a Fibonacci here drawn in orange from the top to the bottom. The initial push up here from the bottom was the 618 Fibonacci level, and we'll see we topped out specifically exactly at that level. So we know this Fibonacci is valid. We also know that if we look back in time, obviously we didn't know where the bottom was going to be until this was in place. But if we look back at that previous low, that lined up perfectly with the 236 in hindsight. And then the previous low before that lined up almost perfectly with the 0.5 as well. And then again, we see, you know, very clear correlation with those levels on the way down. And then on the way back up, we hit the 618. We come back down, find support on the 236, come back down and basically retest those lows. And this starts to look a little more like a descending triangle instead. But we don't sell off violently down to there. We have more of just like a wick. It gets bought up pretty aggressively. And then we start to see some resistance here at the 382, but we hold the 236. And now here we are back at the 0.5. So what we're paying attention to now is, are we going to break above this level and retest the 618, potentially even higher? Or are we going to find resistance here, come all the way back down to the 236 and just continue to fill out this triangle pattern? Either one is obviously possible. We still have momentum in our favor on the daily. We are still inside the bullish control zone on the daily, and we have the 8 and 21 cross to the upside. But we are currently at resistance based on that 0.5 Fibonacci level, based on the top of our pink resistance here as well. So this, in my opinion, you know, I keep hearing a bunch of people saying, this is it. This is the time to buy gold. This is the time. If you're not holding, it's your last chance. Last chance to get gold. It's getting hard to find. It's getting scarce. Blah, 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 blah. That's the exact same thing that we're saying right here. Last chance before new all-time highs. Last chance before new all-time highs. Last chance before new all-time highs. You know, same thing up here. Last chance before gold 10,000. So fight the FOMO. I guess that's all I have to say. You know, if you're not currently positioned, I would rather buy into momentum after a breakout, consolidation, and continuation than, you know, buy into resistance and then see a pullback back down to the bottom of the range where I would expect us to find support. Overall, this is a bullish pattern. Overall, the environment, assuming the inflation trade is still on, assuming People are afraid of inflation, and then it will persist into the future and continue to rise. And we keep seeing these big CPI prints, and everything's going to cost more money. I would expect gold, obviously, to rise over time, as people do de-risk a little bit from some of the speculative assets. But I'm just not sure that that's the case. In a risk-on scenario, I don't think gold does that well. And also, if oil starts to, subside, I don't necessarily think gold is going to do that well. I think more realistically that we might see miners outperform gold, and they might be better because they're going to be more profitable with lower oil prices if gold price was to stay the same, etc. So, but again, just paying attention to that, watching what's taking place. And now I want to switch out to the weekly, and I want to pay attention to something very key on the weekly that once again has me very skeptical of this move as well. So let's look back at, obviously this was the high from 2020 on gold. Let's look back for some similarities from the high back in 2011 and what happened to the people that got overly bullish at the wrong time here. So we put in obviously a new all-time high in US dollars, came down, found support, a lower low, lower high, and then once again lower high, and then put in, essentially like same low. So we now have what looked like a descending triangle taking place, obviously a predominantly bearish pattern. Looked like we're going to come down here, potentially break to the downside. We had crossed 8 and 21 to the downside, and then all of a sudden we burst back to the upside. It gets extremely bullish as it looks like a technical breakout, but then what happens? We essentially come back up and retest that previous high, and we get what amounts to like a double or triple top after the all-time high. So we have an all-time high, and then we have what amounts to basically a triple top, and then we end up crossing the 821 downside, and then we actually break down below the 200 exponential and simple. We retest it. It fails to act as support. We fail to break back above it. I should say it fails to act as support here. And then we fail to break back above it, fail to break back above it, and then we go into a bear market. So remember, this topped in 2011 basically, and then we are in a bear market and finally put in a low in 2015. So for 4 years, it just bled out and lost roughly, from the high to the low, it lost 45% of its value. So if you bought into the fake out, if you bought into the failed breakout right there from the high to the low, you lost over 41% of your value, with FOMO. So definitely very cautious at this level. Obviously, once you broke down below, this key support right here, you should have known to get the hell out. Or once we broke down below 200 exponential, or once we flipped the 200 exponential and simple over to the downside and entered into a confirmed bear market, whatever. But regardless, if you did not, if you entered a position right here and were trapped in that position, that was in October of 2012. We did not reach that level again until July of 2020. So you spent 8 years trapped upside down in a position because of your FOMO, when all you really had to do was just let the price go up another, potentially, if assuming you were going to buy the breakout, another 7%. So you were 7% away from a new all-time high and then buying into momentum versus FOMOing in and losing 12 years of your life or 40-something% of your value. So, and that's dead money. If something's sitting around for 12 years, and you're underwater in it and you're just hodling it, you're just holding, you're just praying and hoping and wishing, that's dead money. And you're no longer an investor. You're a hodler, and you failed. So basically, once we started to see the retest of the 200 exponential and simple, we finally broke back above it. This is when I got extremely bullish on gold. Anybody that knew me or was following me at the time knew that I made the call on the breakout of gold above the 200 exponential and simple. Once we broke out, came back down and retest at roughly $1,300 is where I got extremely bullish. I actually was at $1,350 on the break. Well, I was starting to get very bullish right here, but I was still skeptical because of what had happened here where we flipped the slope line back over and then came down lower. But once we broke through this resistance level right here, which was a very key resistance, I got extremely bullish on gold at just above $1,350. And then we obviously had a very nice run up from then, roughly like, over 50% in that amount of time. So instead of just sitting around dead money, we were able to capitalize on that move and then get out, with a 40 to 50% profit and, not just sit around. We were able to use that money somewhere else in the meantime. So now what I'm looking at right here and what I'm seeing is a very similar signature. Now the same thing does not have to happen again. We do not have to top out right here. But again, look at this. We have a all-time high and then we have a 1-2 triple top breakdown. And here we have an all-time high and then, potentially a, 1, 2, potential triple top breakdown. So the real level to invalidate for me and to actually get bullish on, what's taking place right now for me is I really want to see us break above the 618 and then consolidate and potentially get the measure move breakout of the actual flag itself. And then obviously if we just kind of zoom out here once again, we can turn off the auto and we can see that I have just taken the pole, which is basically just the move up to the consolidation pattern, and then just extrapolated that as a breakout of the actual flag itself. So let's just assume we broke out right here. We would essentially expect a target of 2750. Would gold probably go much higher than that? Sure, probably would. What does the world look like that? Who knows? Hyperinflation, the world's crumbling. I don't know. I don't know what happens. Maybe a million different things. But the fact of the matter is, on the weekly here, we have flipped over the slope line blue. We have momentum in our favor. We're above the zero line. We're above the slope line. And we're seeing green histograms. So while that does look good, again, we have to be very, very careful because this is, let me just switch back over here one more time. This is essentially what we saw right here. We broke out above, let me just zoom in on this. We broke out above the zero line, above the slope line, multiple green histograms in a row. We flipped the slope over blue. And then what happened after that? That was the absolute top. That was literally the absolute top when it flipped over blue. We're inside the bullish control zone. We then exit the bullish control zone. We get the hard sell signal. And then we go into, 12-year downtrend consolidation, 40+%. Gold is dead, blah, blah, blah. So again, very, very similar to what we're seeing potentially take place right now. So while I am cautiously ambitious for gold and gold prices and the future of gold, I am cautiously ambitious because I do not want to. I refuse to be trapped in a situation like that personally, but don't want other people to be trapped in that situation as well. Part of me is pulling for old Peter Schiff there. It sucks to be wrong 98% of the time. But yeah, that is our gold chart right there. And then let's look at our silver chart as well. So silver obviously has a little bit cleaner of a pattern. We saw a little inverted head and shoulders down here, broke out from that after the technical breakdown of a key support, which was essentially this channel that we were operating inside of. This was starting to look pretty bearish. We were able to reclaim that level though. Excuse me. And get our reversion to the mean, the retest of the 200 exponential and simple, which, obviously we are under. They have flipped over bearish. So on the daily, we have technically entered into a bear market at this $25 range. We're attempting to reverse that now. We're above the 200 exponential. We've put in a larger version of an inverted head and shoulders. So we have obviously our left shoulder, our neckline, our head, our neckline, our right shoulder. Didn't quite get to where I was expecting it, but roughly. And now here we are breaking through our neckline, potentially going to get the measure move, which is again from the head down here to the neckline right there. So that measure move would potentially take us back up to the top of the range, the same level that we have gotten rejected on over and over again every time we got there, which is roughly 28.50, something like that. So again, while I am cautiously bullish on silver, I am cautiously bullish on silver because, it still doesn't look great. There's definitely starting to show some life, some potential, but it doesn't look great. So essentially what I'm seeing here is, again, same exact thing. Now the difference is silver topped out in 2011 right here at its previous all-time high of 50 something dollars. But when we came back up, we were not able to get back to that same level. So here gold was making an all-time high, and then this run back up, gold made an all-time high again. Silver did not even come close to its all-time high. If the all-time high was just by candle closes $48 to $50, we basically came up 66%. We only made it up to $30 this time. So silver is arguably much less bullish than gold. So while people are saying it's undervalued, it's underperforming. I'm not sure that it's necessarily undervalued. There's a strong argument for it being undervalued, but also, do we buy the strongest horse in the race or do we buy the weakest horse in the race? So if your argument for investing speculatively in silver is that it's undervalued because it's the only thing in existence other than basically, uranium and oil that have not put in all-time highs, that's not a good argument, in my opinion. You're basically buying a loser. Why would you buy a loser? Why not buy a winner? So, buy something that's putting in all-time highs now. But again, I don't use silver necessarily as a speculative play. I use gold and silver more like a, insurance policy or savings account for my gains from, investing or trading in other assets. So, and obviously like the insurance factor, imagine if every month you pay your car insurance, your house insurance, your health insurance, and if you don't use it, they give you, a gold bar instead. That's how I look at gold. You're basically just putting that money away. It's an insurance policy. If something goes wrong, you have it, but you hope that you never need it. The difference is your premium doesn't just go to nothingness. You get it back in a form of a shiny gold or silver bar. So, but here on the weekly, we have broken back above the 200 exponential and simple. The 200 exponential is above the 200 simple. We essentially got that reversion to the mean move. We slightly front ran it right here. But I'm not convinced that we don't come back down and touch it eventually. So while there's still some serious potential for a retest of silver in like 21 or possibly even the teens, to me that looks like a buying opportunity. So, but again, cautiously optimistic on silver because it is an underperformer for a reason. It's underperforming for a reason. There's not enough buyers or there's too many sellers to push the price up higher. So what does that tell me? Well, until something fundamentally or, technically changes, it's still a loser. So we don't bet on losers because we're not buying lottery tickets here. We're investing, we're trading, we're doing intelligent things. So while I do love silver, I do hold silver, I am optimistic on silver, I'm not an idiot. And then finally, while we're looking at it right now, we can go ahead and talk about something very important here. Since I talked about this, I have actually heard some other people talk about it as well. So it is kind of nice to know that I'm not the only person that actually sees this. But we basically have like the world's largest cup and handle pattern ever developed on silver. And again, we spoke about the cup and handle a little bit earlier, but let's take a look at what we're looking at right here. So obviously we have our double top. This top right here is from the Hunt Brothers 1980, or no, this is the 1980 top. This was the Hunt Brothers top right here. But we basically have a giant cup that we have formed now. Obviously the low being down here, you can kind of draw this however you want. But, we basically topped out at $50 in 1980. And then we bottomed at $3.50, roughly in like 92. And then we double topped here in 2011. And now that's our cup formed right there. And now if we look at our handle, what is the stipulation or, what is the strongest type of handle? Well, this is exactly what we were talking about, where the number one strongest handle that you can get is basically a descending channel. So depending how you want to draw it, I would argue that it should be drawn like this, but you could draw it however you want to. But typically, or the strongest type of handle formation is a descending channel. You finally get the descending channel break. You hold the top of the channel as support. You can still put in a low after that, but you don't make your way back inside of the channel. You don't break down into the channel. So here we have the beginning of our handle pattern forming, the retest of support, as resistance as support rather, consolidation pattern, and then we get that break to the upside. Obviously, this little anomaly like paper trade sell-off in silver took us down to like, what, 11.50, but that was not real. Obviously, you couldn't buy like spot silver. It was still like $25 to $30 with premiums at that time. So, but again, we have now formed what amounts to, not completed, but what amounts to our handle pattern here. So we can just kind of drop this in place. When is this going to play out? When does this break out to the upside? Are we almost there? Is it going to happen tomorrow? Is it going to happen in 10 years? Well, we don't know that. We have literally no idea. But at this point in time, we have a giant cup. We have a technical descending channel. And then we have our handle formation as well. And then obviously we know for a cup and handle move, this is where silver starts to get excited. We can measure from the bottom of the range all the way up to our neckline or like the top of the cup. And that's going to give us our measure move breakout. And assuming we do ever actually break out of this pattern, we'll put our breakout level at that. And then we can kind of zoom up and see our target. And we'll see our target is roughly like $90. So a breakout to the upside, a technical breakout of this cup and handle would have a target to the upside of $90. Now, is it possible we go much, much higher if we break out of a pattern that we've been in since 1980? Well, yeah, definitely. Definitely is much, there's definitely potential for a much higher target. And the way we would get that, obviously, based on technicals, not just like Moonboy made up fundamental targets where we say silver to 1,000, silver to a gazillion, silver's going to rule the world, silver's unobtainium. No, we'll look at actual Fibonacci extension targets. In this case, my macro target. Obviously, the 1.236 would be that $90 range. The 1.382 is not really one of my main targets, but that is 130. The 1.5 is 177, but overall, my target to the upside on silver is the 1.618, which is $240 per ounce. So do I think we go to $240 per ounce anytime soon? No, we probably never break out ever. Silver probably goes back down to $10. No, not really. But let's not get excited, okay? This will probably, based on history, we will all be dead before silver ever breaks out to the upside. But if it breaks above that $50 level, that's when you'll hear me singing a different tune, talking about this is it, it's finally happening, now is the time, you know, et cetera, et cetera. But until that happens, you know, it's just going to look like a potential, you know, just another top. And more than likely what happens is we get back up to that, we push slightly higher, and then we sell back off, consolidate for another like 5 years, whatever, et cetera. So, but roughly, you know, just kind of like looking into the future, you know, this is what, pointing to like roughly, what, 2025 or something like that. So, you know, we've got some time before our little technical breakout happens. Now, this move right here, though, could happen very quick after that. You know, we could see that by, you know, 2028, 2030, we could see $250 silver. And that's where that's going to line up with like your EVs and like battery technology and, you know, electrifying the world and solar and all this other crap, you know, that people are talking about. Is it realistic to me that that's like, you know, a process that happens over the next 10 years? It definitely is. But for the people that are calling for like silver squeeze 2.0 and like the Wall Street silver guys and all these people that are like, this just isn't fair. They're holding down our prices and we can't get our silver pump and they're mean. It's manipulation. Well, get used to it because it's been going on for, you know, 40 years and it's probably going to be going on for a lot longer than that. So, you know, chillax, invest in some other things and, you know, wait for your time. Don't just sit around and give yourself a coronary, you know, waiting on the pump and getting mad at people like old Arcadia Economics, where the dude looks like he's about to like have an aneurysm every time he talks because he's tired of the manipulation. But anyway, you know, I'm definitely a beneficiary of the, you know, silver bulls because I win if they're right. And then I also win when I get to see them cry like little bitches. So that is our silver chart, XAG, and the macro outlook on that. You know, obviously have some long-term price targets to the upside. But again, we're at a very difficult level right now just to get above this 200 exponential and simple. And then once we get there, we're going to run back into resistance again at that $28 range. And then depending what gold does, you know, do we get the triple top breakdown from then? Do we go sideways forever? Do we lose a bunch of value? Or does silver go to the moon? Well, only time will tell. Now let's look at our gold silver ratio chart here. Man, these charts are getting ugly. I might have to just redraw these soon. So this is our gold silver ratio chart. Obviously on the, let me switch over to the weekly actually. I prefer to look at this on the weekly just because it goes back so far. It gives us a little more accurate of a view. But this was our CVD top right here, all-time high for gold to silver ratio. It was taking 128 pieces of silver to buy 1 piece of gold. Obviously blow off top and then we break down from then. This entire time was when you should be investing in silver instead of gold. And then once we bottomed right here, we got the cross back up between the 8 and 21. And this is when I was talking about this is the time to be investing in gold over silver or putting your savings in gold over silver. Again, I'm not saying sell your silver or sell your gold, but, you know, if you're going to put a certain allocation, you know, or profits from your trading account or, you know, whatever your daily, weekly, monthly, you know, investment is going to be, you know, this tells you which one you'd rather be investing at the time based on if silver or gold is under or overvalued. So essentially we get that move back up here. We get the reversion to the mean, the retest of the 200 exponential and simple. Obviously we were below it. We were technically in a silver bear market while we're under this in comparison to gold. And now here we are trying to consolidate and move back to the upside. So we still have momentum in our favor. We had the hard sell here around the top. You know, obviously broke down from the bullish control zone. But what we're paying attention to now is, does this come back down and essentially form another one of those head and shoulders patterns, the inverted head and shoulders? Do we get a slightly lower, you know, gold silver ratio? So it only takes 70 pieces of silver to 1 gold as silver runs back up to that like $28 level, as gold runs back up to that triple top, and then it fails and we break to the upside on this chart, telling us that we're probably breaking to the downside on the underlying commodity. Or maybe gold is going parabolic to the upside, but silver's just kind of going up. Well, we don't know. We'll have to wait and see. But what this tells me is more likely than not, we're going to consolidate here for a bit, and then we're going to get at least one more retest of the 200 exponential and simple. And then if we just look at my target to the upside, again, we had a very clear resistance along the way, broke out of that resistance. We had essentially a descending wedge. We get the breakout of the wedge, and now we're looking for the measured move, which is going to take us somewhere between our Fibonacci levels, which if we take from the top Fibonacci to the bottom Fibonacci here, that would give us roughly a move back to the 0.5. We have already reached the 236 here and fallen just short of the 382. The 382 lines up perfectly with the 200 simple. So that is my initial target to the upside. And then after that, my 0.5 is my target to the upside. So we'll wait and see. We'll see what happens with that. Maybe I'll be wrong. Maybe it underperforms. It gets rejected here and silver starts going bullish while gold, is not as bullish. Again, we have to just wait and see. But I think more than likely what's going to happen here is we're going to see this continuation. Now, again, before I hurt all the silver bugs feelings, if we look at this chart here, let's go to the monthly real quick. We can just keep in mind, based on what happened in the past, this was the all-time high in gold back in 2008, and then gold sold off in comparison to silver, and this was the top in 2011 of gold and silver. So that was when gold reached all-time highs. That was when silver retested its $50 all-time highs. And then at that point in time, it has been better to have gold in comparison to silver since then. And then obviously gold put in a new all-time high right here. So we have a high, we have a low, we have a higher high. So now what we're paying attention to is this the lower low, or are we yet to put in the lower low on this chart? So now we can just look at a couple of little technicals right here, and we can see that if we took our Fibonacci targets from that previous high right here to our we don't even need to use that one. Sorry, I don't know what I have drawn right here. Okay, yeah, all right, I'm sorry. That high right here to the low right there, the initial sell-off, that 1.618 Fibonacci extension was the all-time high that we put in on this run, a decade later or whatever. But regardless, that's not what we're paying attention to. We're actually looking at the other way around. From where we bottomed right here till we moved up to the top, I have this blue Fibonacci extension target in place. So that was our bottom to our top of what amounted to the A wave down, the B wave up, and then the C wave down for the retracement. And the Fibonacci extension target we reached was the 3.618 to the downside, at which point in time we started going back in the uptrend, et cetera, et cetera. And then we have a macro from the bottom right here, Fibonacci, to the all-time high right here. So the all-time low on this chart to the all-time high on this chart. And then we'll pay attention to our pullbacks. And when we came down, we pulled back exactly to the 0.5 in green right here. So we did a 50% retracement of this. So is it possible this bottomed and now we're going to go back up to the 236? Or is it possible that we bottomed temporarily, we're going to come push up here, and then we're going to go lower? That's what I think will happen over time. I think we're putting in another ABC correction. So is it possible the B is already in and it's done? It is possible. But I think more likely than not, we will get a push back up to that resistance or to the 236, because from the 0.5 to the 382 to the 236 will be a 2 fib level bounce, which obviously is something that I see very common happen. We also have a hard buy signal coming out of the bearish control zone. We also have multiple green histograms as well. Now that took place at the absolute bottom of the pullback. So is it possible we already did the ABC? It is. Is it possible we did the A and the B is done? It is. Is it possible we continue up and put the B in higher? It also is. But I think over time, we will see a lower high on this. A lower low on this. And my target to the downside would be somewhere between the 1.618 and the 2.618 of that same move. So we don't know where that's going to be yet because we haven't confirmed where the B is. But assuming we already put in the B, if we look at from the bottom right here to the top right here, our 2.618 is going to give us the target of the 786 of the macro right here. The 3.618 would be way lower right here. But for all those massive silver bulls out there, we're talking about like a 32-to-1 silver to gold ratio or a 41-to-1 silver to gold ratio. So, there's definitely some potential for these like crazy gains. Now, if we come all the way back up here on top at the 236, a sell off to the 1.618 would give us roughly a 50-to-1 gold silver ratio. The 2.618 will give us a 34-to-1 gold silver ratio. So there is definitely some reason to be bullish on gold and silver into the future. But again, we have to be very cautious because, we're looking at a top in 2008 and then a top in 2020. So we're talking about like 12-year commodity cycles, not some little bullshit like 1 or 2 year cycles where if you got to take a little drawdown and you got to just hodl through, you're going to be okay. No, these are long, painful cycles. So, but yeah, there we have it. And we can just look at the daily really quick while we're at it. The thing I'm paying attention to on the daily right here is, we basically entered into a bear market on gold silver ratio in July of 2020. We were able to get back above the 200 exponential on simple. We flipped them back over blue here in September of 2021. And now here we're finding support, potentially putting in a daily head and shoulders, which would be like, push down, retest, try to maintain these levels. If we consolidate here long enough, though, like I said, I expect continuation to the upside. If we fail to hold this level and sell back off, that would confirm to me that we have put in the A, we have put in the B, and that silver is going to go parabolic in comparison to gold. So, but yeah, there's a deep dive on gold and silver and the ratio between them. Hopefully there was enough good news that the, gold and silver, hodlers out there, or like the gold silver cult, as I like to refer to them, aren't too upset with me. So, so next we have platinum. Obviously there's some reasons to be bullish on platinum, but look, again, this is like the ugliest, worst chart you could ever look at. So if you like losers, you like underdogs, platinum is a great place to put your money. Platinum topped out in 2008 at roughly 2,200, and then obviously went back down to $700. So it lost 66% of its value, came back up here, topped again in 2011. The same time, obviously gold and silver at a lower high, and then sold off, and then actually put in a lower low in 2020. So now here we have come back up here, and we are retesting the 200 exponential and simple, trying to reclaim these levels. Technically, 200 exponential still has a slope to the upside. 200 simple still has a slope to the upside. But we really need platinum to get above $1,200. So there's a strong argument that platinum, its main use obviously is like catalytic converters and potentially like EV usage. So there's a strong argument in the future platinum will go parabolic. It is definitely undervalued in comparison to gold, as it typically trades like 1-to-1 or even like higher value than gold. So if gold is at 1,800, platinum's at 1,000. You could argue it's undervalued. I would argue it's undervalued for a reason, because, palladium obviously has stolen its thunder, but platinum is obviously better overall than palladium, especially at these prices. So, but realistically, what we have to pay attention to is what's taking place on the macro platinum chart. And what I'm seeing take place is we have a high, we have a lower high, we have another lower high. We have a low down here, we have a lower low, didn't come back down to the bottom of the channel. So that's good. I mean, it's okay. We obviously saw a bunch of support on the heart line right here. But now here we are running into resistance at the 200 simple in the top of the channel. So what we need to pay attention to is, are we going to just come back up here, get rejected once again, and then come back down lower? Consolidate here for a while and then eventually break out? Are we going to break out right now? I mean, who knows? Who knows? But platinum looks absolutely terrible. I mean, it's been a massive underperformer for a long, long time. But if the breakout does take place, if we do get the breakout, we would expect that breakout to take us back essentially to the previous all-time high. So about $2,000 platinum, which is going to give us, roughly 100% move to the upside. So, but we have to be very careful, with something like platinum, because, it's a massive underperformer, and it's an underperformer for a reason. They replaced a lot of its usage with palladium. So, maybe that's going to switch in the future, as this has been undervalued for some time now. So eventually you switch over, you start using platinum instead of palladium, or maybe the EVs, whatever it is. So, but in the meantime, definitely the slowest horse in the race, so to speak. So let's look at some of our miners here. Here we have First Majestic, silver, and now they have some gold assets as well. So, obviously got our top back here in February 2021. We have broken down below the 200 exponential and simple. We confirmed technical bear market based on the way I confirm them, which is the slope of the 200 exponential and simple. We got a pushback up to the 200 simple, came back down to the 200 exponential, and it looks like we are barely hanging on by a thread for now. So we got to pay close attention to this. What we don't want to see happen is we don't want to break down below these levels right here. Let's clean this up a little bit. It's been a while since I've updated this chart. So we have a very clear support line through here. Once we broke down from that support line, we've now come back up. We're retesting it with the moving averages. And then shorter term, we have a support line right here. You know, obviously bounced it a couple times along the way, and now here we are at it again. So we don't want to break down from the support line. We would rather find support here, push back up to the 200 simple, reclaim this level, and then move back to the upside. So, and obviously I have some very large upside potential targets for First Majestic. But the most important thing on First Majestic that I like to look at and that I'm paying attention to is this gigantic macro pattern. This goes back to 2009, our all-time high back here in 2011. And then we have basically just putting in like a triangle pattern or a flag, whatever. So we broke out of that pattern here, that purple resistance, came back down. I wanted to see it hold as support, but we broke down from it. But now we have reclaimed those levels. So in the event that we consolidate here long enough, I would expect this to break out to the upside and give us our measured move here in blue, which is the measured move of that triangle, and going to give us a target of like 36.73, which is, you know, almost a 3x from this at this point. So it's definitely good. You know, but a breakout of this technical pattern would probably take us much higher. That's just like the initial conservative measure move. So while once again, I got to say, cautiously optimistic on First Majestic and, you know, the miners in general. So SILJ, you know, a large portion of the Silver Junior ETF is in fact First Majestic. So you could argue that this is just, you know, a more diversified play on First Majestic, as you get a bunch of other like miners in there as well. If we go into like a massive silver bull run and put in new all-time highs, I would probably rather own SILJ because of the exposure to some of these other like shit miners. But again, you don't know what's going to happen. So, and some of the juniors that are available in this or that compose this are not available except through like OTC markets or at all in the United States. So it gives you exposure to something you might not otherwise have access to, depending on where you're located around the world. But overall, pretty much same thing. Not a ton to look at right here. Basically doing the exact same thing with our moving averages. So next we have the Gdxj. This is, you know, gold ETF juniors. Again, this is, you know, there's obviously like the juniors are going to be like a little more speculative, but theoretically have a little more like upside potential. So a little more risky, but maybe a little higher reward if they pay off. So depending how we want to draw this, you know, obviously up to this point right here, we had a very clear couple touches along the way right there. So I would argue that it should be something like that. I think this is probably the way I would look at it. You can rationale however you want. That, you know, this was the way it should have been drawn the whole way. We got a bunch of like clear touch points, the heart line, the bottom, the top. This was a failed breakout or a fake breakout or a throw over or something like that. Come all the way back down to the bottom. So the real question is, you know, is it going to happen again? Am I just not good at drawing stuff? Should it really just be right here and I don't know what I'm doing? Maybe. I mean, you can draw it however you want. But I would draw it this way, and I would say that the danger is a failed breakout situation like this, or a throw over, or a fake out, whatever you want to call it, which is basically where we're at right now. So if I see a consolidation here long enough, a retest, and then we start to push to the upside, I will start to get extremely bullish on this based on what like gold and, you know, obviously silver as well prices are doing. But in this case, obviously more so gold. But, you know, 55 is going to be the real level that I want to see us break above. As a break above this previous high right here is going to make me pretty damn bullish on Gdxj. So, but we'll have to wait and see. Obviously, we could slap a little Fibonacci from the bottom right here to our top right there. And we're going to go to a couple other key levels, see if it was trading technically. Do we see like some serious... No, obviously we didn't have the top in yet, but we see that was the top at the 236. We see, you know, some support at the 382, and then we confirm the top. So looking back in hindsight, we see, you know, some clear correlation between them, you know, which is arguably because bots and algorithms had preset that target in advance, you know, market makers, etc. Not seeing a ton of correlation on the way down. Some little moves on those, but nothing too crazy. Nothing that's like, oh shit, that's it. you know, it's perfect. Everything looks great. So we'll have to wait and see what happens here. But obviously a nice consolidation and then start to move to the upside here is going to look really good. But we'll be looking at that 55.36 mark. So. All right, next let's do copper, CPER. This is the United States Copper Index, but essentially all these different copper funds that I am invested / trading pretty much look the same. So you can look at any one of them. I'm going to tell you the same thing as CPER is, or basically spot underlying. Obviously copper at all-time highs, actual copper. This may sound stupid, but just so people know, a lot of people have gotten into like metals and hodling or buying physical gold, silver, and copper as well, because they offer, you know, platinum and gold and silver and copper and everything on these exchanges. Don't ever buy physical copper, ever. Don't ever buy it. People will say, oh, copper's trading at, you know, $5 on spot, and I can buy it on the exchange, or I can buy it on you know, from this company, you know, bullion company or whatever, for only $3 an ounce. Well, it's priced in pounds. It's in pounds. And then when they sell you those little bars of copper, it's in ounces. So you like think you're getting a good deal, but you're paying like 10 times the price. So please don't ever buy physical copper. Ever, because you're paying a massive premium. I mean, it looks cool, it sure is pretty, but like if you're gonna collect copper, like collect like shiny pennies or something like that. Don't collect the bars. But anyway, so we obviously see, you know, a retest of the previous highs on the index here. Definitely, you know, this was our W pattern we spoke about. Obviously this is when you know, we basically put in a W at resistance, and then the breakout was the distance from the bottom of the second V, you know, to the top of the W or neckline, etc. So we obviously hit our measure move, which was also the 1.618 of our top of the V to the bottom of the B. You'll see the Fibonacci extension right here. It's the 1.618. So as far as I'm concerned, copper has topped out. Can it go higher? Sure, maybe. But this looks extremely toppy to me. And obviously we hit my target to the upside. We even hit target to the downside and then got the push back up, at which point in time we obviously got a pretty clear rejection. This is a pretty clear rejection candle to me. And now we're bearishly, you know, we're eating that candle for lunch. So we got a push back up here, attempt to go back to highs. It got rejected. And now we've only seen like consolidated selling since then. And on the monthly, we now have the hard sell signal. We have left the bullish control zone. We have a bunch of red histograms in a row. So as far as I'm concerned, copper has topped out. The last time we saw that similar signature was right here, and that was at the top of the V, or, you know, the W central point. Which point in time we basically sold off and gave back like 80% of that move, you know, which from that top to the bottom there, you know, just by closes was 36% sell off. So realistically, what would I expect to happen right now? Well, assuming this is the top and we're going to sell back off, I would expect us to come back down to that V, the top of the V, or like the center of the W. And I would expect, you know, roughly another 20% to the downside, somewhere around like a $21 target on this. So doesn't have to happen, but looks likely. And obviously I have the green box in play because that is my target for a re-entry. So, yeah. Oh yeah, snap it to a copper. All right, let's look at a couple other commodities and then probably going to call it there. So lithium is next, LIT. Obviously got up finally. Well, we hit the 1.5 initially, finally got up to the 1.618. Actually like overshot it slightly. Starting to look a little bit toppy on the daily. Not quite as bad as the copper chart we were just looking at. But if we zoom out and go to our monthly chart right here, we can see that, you know, basically we took the high from 2011, we took the low from 2015, put our Fibonacci extension in place, and that gave us our 1.618 target up here. So while I would normally like to see us, get all the way up to that 1.618 target, we got so close, you know, literally within a couple pennies, and just front ran like our $100 target, as far as I'm concerned, I call that like, that's okay with me. You know, we literally made it up to 96.85 and the target was like 98.56 and, you know, $100 roughly. So as far as I'm concerned, I would not be surprised to see us push back up and complete the, you know, algo, hit that target. But at this point in time, seeing it top out at least like short to midterm, would not surprise me either. So I do expect at some point in time a retest of this 75.22 would line up right around that 200 exponential and simple. While this looks slightly stronger than some of the others, we are seeing a bunch of red histograms still above the slope line. It is still blue. We have the hard sell signal leaving the bullish control zone, and the Stokes are angled to the downside. So we're trying to maintain the 821 cross for now. A couple closes below that 91.86. It's going to start looking pretty bearish. So, but again, not for like a massive move down. Just pull back to like about 86, which would be a short-term opportunity for like a scalp or re-entry position. Hydrogen, HYDR, that hydro. So we obviously saw a long consolidation pattern, breakdown from that pattern, and then we broke all the way back up to the top of the range, consolidated, and then got our breakout. We overshot our target of the 1.618, which is basically from our, initial point to our bottom right here. And then, slightly above that was 29. So now we've come back down, broken back in, starting to show a little bit of weakness on the daily. But again, I'm looking for a similar move. We have a very clear resistance here that acted as resistance. We broke through it, left a slight gap, but we never actually retested that. So what I would like to see is basically a retest, see that hold what was previously resistance, hold as support around like $25. And I think that would be a nice entry into this. So again, we're seeing a hard sell signal. We have left the bullish control zone, a bunch of red histograms, still in between the 8 and 21, but definitely showing some weakness. So a breakdown below 26.89 is going to start to look bad. But if we take from our low to our high right here, let me just switch this over. So if we just look at our green Fibonacci that I have just put into place from the low to the high, we have slightly front run the 236. So if we confirm a touch of like 26.77, it's going to look like basically this is at least putting in a short-term top, and then a pullback to our previous like resistance that we would hope to find support at would be somewhere in between like the 0.5 and 382. So it'd be a respectable pullback, followed by like potential continuation to the upside. So, and again, I'm very bullish on these long term, but short term they've already had some pretty nice runs. So. And then lumber, let's take a look at lumber. So obviously, lumber, I've been looking at this potential for a giant head and shoulders topping pattern. Was playing out very nicely. Obviously had a beautiful play off of the, neckline of the head and shoulders with two key targets. Went into a bear market back here. Obviously, called out like that it was time to get the hell away from lumber at about 13.88 when the 821 crossed the downside. And then obviously we took the move back in here. 821 cross back to the upside. Trade set up at 531. 38% target to the upside, 76% target to the upside, and we topped out on the reversion to the mean retest of the 200 exponential and simple. Since then, we have basically been selling off, but we did have a recent $100 rally. What we want to pay attention to here is, do we put in a lower high and get rejected off the 200 exponential? Do we complete this move to the upside and get a touch of the 200 simple and then get rejected? Or are we able to reclaim those levels and then potentially move back to the upside? I'm still overall bearish on lumber, but as of now, it doesn't look terrible. But more realistically than not, we probably get rejected at one of these levels after that little pushback up here. So, but we have broken down below. The slope line is now red. We're getting a hard buy signal coming out of the bearish control zone on the daily. So it looks okay. But when we switch out and look at our weekly time frame, we will see that, we have basically... we basically bounced the 200 exponential and simple, and we're trying to reclaim the 8 and 21 for now. So we're at the 21. If this gets rejected, we would expect more continuation to the downside, chopping through like this 200 exponential and simple, and then eventually the break-in measure move. If this holds right here, the key area to look for would be that 808 target. And if we can take out that 808 target, I would expect continuation to the upside. So, yep. What'd he say? And looking at the monthly again, this looks like just the retest of the 821 to try to stop us from entering into a, monthly, drawdown to retest the 200 exponential and simple again. But we did get the hard sell on the monthly. We do have all red histograms on the monthly, and this sure looks like a reflex rally off of the blue slope line. That more often than not, we would expect a rejection and continuation. So we shall see. But if lumber starts pumping back up again and starts going up to new all-time highs, that sure is going to feed back into like the whole inflation narrative and everything. So, so next we have USAS, American Gold and Silver Corporation. Got a nice bounce here off of that long-term yellow trend line. Have a couple trade setups currently in play that I'm currently in from our entry back here at like 80 cents, and then obviously off support as well. But expecting a 93% total move to the upside. Having a little weakness in the meantime, but overall still looks good. Still have momentum in our favor. And that would just be a retest of the 200 exponential and simple and the 0.5 Fibonacci extension or Fibonacci retracement. And then also we have a move all the way back up to the top of the channel, 250% move to the upside, which would give us a target of like $2.75. Looks okay for now. The first move does at least. This one's probably a little stretch. Let's take a look at our pot stocks. So obviously got a nice little bounce on some of the pot stocks here. Finally looked like we were potentially trying to put in a bottom. But at this point in time, Tilray on the daily is below the 200 exponential and simple, rolling over, confirming a bear market. The last time this happened, and let's hope that it's not going to be the same type of scenario, but this was the all-time high back in 2018, broke down from it, tried to reclaim those levels, and then weren't even able to get back up to the 200 exponential and simple. Here we broke above them back in 2020, 2021, confirmed the bull market at about $10, ran all the way up to like 60 something. I got out before that. It was like in the 40s. And then since then, we've taken a couple little scalp plays and kept a little bit of our position open off of some of these bounces, some of these lows. We did make it all the way back down below $10 for, a moment. But at this point in time, we're seeing some very clear resistance at the 200 exponential. We want to see this chop out and get a push back up to the 200 simple, our target of like $17.92, but again, we got to be very careful. This doesn't just get rejected and sell back off again. Looking at the balance sheets and everything of a lot of these companies, they look undervalued to me. And then also we have this potential for our macro trade setup, that fucking moonshot, that rocket ship, that pot stock island buying money. We basically have from our bottom here, push up giving us our 1, a 2, pullback would be the 618 pullback from the high to the low, or the low to the high right here. So we pull back 61.8% of the time, and then we move to the upside. We hit our Fibonacci extension target from that move, which again, from the low to the high, we now have pulled back to slightly below the 61.8, but the most important thing is we didn't take out the top of the 1. So with a Elliott wave series, what you want to see is the move of the 1, the retracement is the 2 of the 1, then the move of the 3, then you want to see the retracement of the 3, which is our 4, not sell off lower than the top of the 1 on a long enough time frame, like a daily or more. So that's basically where we're at right now. So if we break down further from this level, it's going to invalidate the potential 5-wave structure to the upside, and it's not going to look good. It's going to look more like an A, a B, and then a C, probably down to like the same low or lower low potentially. I don't think that's likely to happen, but it is possible. Now, in the event that we do actually push back up to the upside from here, if we take into account our Fibonacci extension targets, which is taking from the top of the 1 to the bottom of the 2, we get that 2.618 top right here, which was our Fibonacci extension target of the 3. And then if we just assume, hope, wish, pray that we get the same move from the 3 to the 4, that is going to give us, obviously the initial target would be a retest of the all-time high, or potentially just the $171 to $300 level, which obviously is a massive move from where we're at currently. But a move back up to potentially as high as like the 1.618 Fibonacci extension is going to give us, it's going to give us that retest, the 1.618 of the previous all-time high right here. Or, maybe we get up to the 2.618, which would be the $1,572 level. Maybe we get up from the top to the macro bottom, and we just go to the 1.236 of that, which is the $930 level. you know, sky's the limit at that point in time. Something worked, it's probably legalized, etc. So this could obviously be a absolutely beautiful trade setup, or it could just be another fail and then break back down. So, you know, paying close attention to the cannabis industry for some serious potential crypto-like gains. Definitely some asymmetric risk-reward scenarios. ACB is next. This was starting to look like a head and shoulders bottoming pattern, but you guys know how I feel about them. When we go sideways long enough, it no longer looks symmetrical. It doesn't look pretty. But at this point in time, you know, we're potentially putting in a little mini head and shoulders inverted right here. Breakout. We've retested 200 exponential and simple. You know, if we consolidate here long enough, we want to see a breakout and then potentially that move up to $18. So if we're at $8 right now, you know, we're talking about a pretty nice move to the upside. You know, like 150% move. Definitely some meat on the bone for that trade. Little momentum building. But we got to be careful because when we zoom out and start looking at these longer time frames, I mean, 200 exponential and simple, we're in a weekly bear market, 100% for sure. We're potentially crossing the 821 back to the upside, which would give us that initial, you know, push back up to 1350, potentially 1650. But realistically, we're looking for the reversion to the mean, the move back up to the 200 exponential or potentially 200 simple, which gives us targets of like between $25 and $45. So we're talking about a, you know, 3x from where we're at now to the 200 exponential, or potentially, you know, 8 to 44 or so. We're talking about, you know, basically a 5x. So 3 to 5x potential on this. Not to mention, you know, if we ever just got back to the previous all-time highs. But again, you know, this is definitely a loser. Everything else in the world but silver has been rallying, but pot stocks and silver. So, you know, just be cautiously optimistic when we're betting on the losers, the ones that never win, the worst assets you could ever buy and own and hodl. Okay, so CGC. Again, you know, we lost this yellow support line right here, broke down below, got rejected on 200 exponential and simple, entered back into a daily bear market. Unfortunately, did take a entry off of like that 1183 level right here, potentially looking for that same move, the reversion to the mean. So far, not getting it, looking much weaker than the majority of the other cannabis stocks. Potential like, you know, 70 to 93% move up here between 20 and 22, currently at $13.60. If we get the move all the way back up to retest the yellow breakdown, which lines up also with our long-term descending trend line resistance here at the top, that's going to give us a potential move of 239% to the upside. You know, but again, so far been a pretty big underperformer, but still cautiously optimistic on these, obviously. And then, you know, when we look at the weekly again, just looks terrible. Well below the 200 exponential and simple, well away from that 821 cross that we're seeing on some of the other pot stocks. We do see a buy, sell, buy signal in the bearish control zone and the cross to the upside, a bunch of green histograms. So there's potential that we're bottoming here, but typically, you know, of course, there's a bad example. Typically what we want to see with that divergence signal is something like this. We want to see a buy, sell, buy close together to each other, and that's much more reliable. Now, in this case, obviously, you know, it only resulted in a small move, and it actually put in a low before then. So it's not the best example, but, you know, nothing in trading is 100%. It's all probabilities. And when we see them spaced out like this, it's much less reliable. So what we're paying attention to is a weekly exit of the bearish control zone after the hard buy signal with a bunch of green histograms, looking for the zero line to cross over, potentially flip the slope over to blue. And that's probably going to correspond with like our $22 to like $28 reversion to the mean price targets. So, but pot stocks do still look pretty bad. I'm still not convinced they've put in their lows, honestly. Okay, let's finish up with some uranium. So URA, you guys know, obviously, you know, I've been in these uranium plays for a while, been screaming at the top of my freaking lungs from the mountaintops. But here we have a high, a lower high, and a third lower high. Here we have a high, a lower high, and a third lower high. And price action, we have a high, higher high, and a third higher high. We have triple bearish divergence. We have now broken down from our blue support right here as well. We have topped out at a key Fibonacci retracement level. And this was our trade setup that played out, which was roughly a 77% move. Obviously, we have entries from much lower than this, but I'm expecting a target down here, a retracement of basically somewhere around like $23, $24 price target. Retest of the 200 exponential and simple. Still very, very bullish on uranium overall. And when we zoom out and look at, this is URA Global X Uranium ETF. But when we look at the weekly chart right here, this is what we're really paying attention to. Again, this thing has been hated forever. Commodities in general have been hated forever. But in February 2011, this topped out. It bottomed in March 2020. We retested the 200 simple, put in a higher low, broke above the 200 exponential, came back down, retested it, front ran the 200 exponential and simple, flipped over the 200 exponential and simple positive for the first time in a decade. And now we have entered into a macro bull run. Now the real question is this going to be like a 1, 2, 3, 4, 5, and then we retrace the entire wave up? Yeah, probably. It probably will be something like that. Doesn't have to be, but I'm essentially looking at something like this, like, you know, a retest of that 382 level, the 200 exponential and simple, or possibly the 0.5, somewhere around like 1475 or something like that. But that is 100% going to be a buying opportunity for me, as I am macro extremely bullish on uranium. I love that yellow cake. And then again, looking at the monthly right here, we obviously crossed 821 back to the upside for the first time at $12 and have went absolutely parabolic since then. But now we see the hard sell signal coming in and the bullish control zone, potentially losing that level right now at our macro 0.5 retracement from the top to the bottom. We sold off all this way. We retraced 50% of the move. So we expect a potential 2 fib level retracement or 2 fib level bounce. In this case, the bounce would be back down to the downside. So just kind of dragging this to the side here. We could see if we top out at the 0.5, we would expect the initial retracement of the 382 in yellow, but realistically, we're looking to buy the 236 in yellow, which I may have just put too small of a box in on a different time frame, but this is the main area that I'm looking to reaccumulate, which is, you know, roughly like that 1450 level. But again, I'm not going to get greedy on these pullbacks either. I will probably ladder in towards the lower levels of these, but that is URA. And then got a couple other uranium ones we'll just take a quick look at. They're all saying the same thing though. This is UEC. UEC did not print that same divergence because it got that extra little pop at the end, but still, in my opinion, looks very toppy. And that extra pop just so happened to coincide with our macro target of like 573. But again, we're looking at a 1, 2, 3, 4, potentially like 5 extension right here. And if we look at a longer time frame, we can get a little more clear of a picture that this actually played out perfectly. Anybody that has been following the channel for some time now knew that my exact price target to the upside was at 579. And obviously I got into this one a long time ago, but even that most recent trade setup was like a 58% move up here. And it's starting to look a little bit like a blow off top, honestly. But we'll have to see what happens. I do still have one more target to the upside. I do still have part of this position on, but you guys know that I like to take my profits early and often. But potential target up here of like $25 if we break out from the previous all-time high based on our measure move Fibonacci extension targets. So, but looking good right now. We'll have to wait and see what this does over time. But looks a little toppy there. Definitely looks a little toppy. And we hit our target perfectly and everything. You know, I'm not going to get greedy with this one. Same type of deal, though. You know, we entered back into a bull market, retested as support, and then we saw that continuation level from like $1. So we're already up like, almost like 500% it's up from then. So been a nice move in the uranium play, but it's becoming a little crowded. URNM, North Shore, again, similar type situation. We have a high right here. We have a same or higher high, and then we have a higher high once again. Here we have a high, a lower high, a third lower high. Here we have a high, a lower high, a third lower high. We have broken down below the slope line, gotten rejected off of the blue. It has flipped over red, and we obviously put in what normally would be a bullish flag pattern, but it looks like we're getting ready to break down from that, or bullish triangle. Looks like we're getting ready to break down from that. Now, I do want to see this support hold from these previous pushes up right here. I'd like to see that level hold. It did hold back here, but I think more likely than not, we're going to get like the breakdown and like the measure move of the meat of the pattern right here, which would essentially, once again, I'd be looking for a buying opportunity off of our 200 exponential and simple moving average. based on what price action does. Is it possible we just come back down and slightly front run that at like 71, 72, somewhere around there, based on like the previous top right here? Yeah, that would look like a pretty good target either way. But that's what I'm paying attention to on URNM. And once again, we can see the potential bearish divergence getting ready to play out as we have watched it play out over and over again on many, many assets. And then finally, CCJ, Cameco, a little larger of a company, a little bit bigger of a name in the space. Once again, doing the exact same thing. Triple bearish divergence at the top of a wedge, potentially breaking down from it, giving us our measure move retracement to the 200 exponential and simple, and a price target of somewhere around roughly like $21 to $20, somewhere around there. So, but again, I'd be looking at those as a buying opportunity. So, yeah, I think that's good. We'll take a look at this one too. We've been talking about any sphere for a while here, and the potential for the breakdown. And I did notice that this broke down like 15% or something the other day. I'm still patiently waiting on this one. It was like 16% sell off, just that little move. We had a very nice move on this already, but I am still looking for this potential of the inverted head and shoulders pattern, which would be the retrace of our breakdown from the red support down here, and give us our 236 retracement. I'm looking at that at about $3. So, but we are getting closer and closer to my initial target, which is the retest of the 200 exponential and simple and the heart line of the channel, the ascending channel. So I'm paying attention to how price reacts off that 467 mark and may take a position from there. Maybe. But I will keep you guys updated on that. We're obviously, losing momentum. Let's see what happens. This is also not something I want to get stuck in if it decides to just go down for the rest of its life. So yeah, that's it. That's all we're looking at today. Just looked at oil, the DXY, the TNX, and obviously our, some of our commodities as well. We will take a look at crypto and stocks a different day this week. And I'm going to keep these streams a little shorter, go into a little more detail on what I do look at, or potentially just keep them shorter in general, do snippets, something. Just trying to change up the format a little bit. You guys let me know what you like, what you don't like, what I can do to better serve you or potentially get you to, subscribe, share the videos, etc. But, just trying to grow the channel a little bit as I do put a lot of work into this channel, and I have seen growth at a minimum lately. I do just want to talk about crypto real quick while we're here, though. ETH has broken down below the 8 and 21 cross, and now we officially are confirming basically 821 cross the downside. I do expect to push back up here and attempt to save this at 44.22, but we have a bunch of red histograms, the hard sell signal, and we have broken down from that level, so I think that attempt will get rejected and we'll see further downside. And then if we just take a quick look at Bitcoin, we see a very similar signature as well. We see once again bearish divergence playing out. We have a high here, we have a lower high, we have a high here, we have a lower high, we have a high here, we have a higher high. So we're seeing bearish divergence at a new all-time high after finally coming all the way back up to retest that previous all-time high. We see almost no continuation. We see a micro double top, a macro potential double top, and now here we look like we're about to lose the 821 to the downside. So what I would want to see in an ideal bullish scenario is a retest of like the 51,000 range around the 200 exponential and simple, see those act as support, and then see continuation to the upside. That's what I would want to see, but we'll find out in time if that's what happens. And then if we just look at the spot markets here, we'll see we've technically already confirmed the cross to the downside, but a pushback up, again to like 62.5 or whatever seems more likely than not. But again, bearish divergence. Now it is only one drive or 2 points of bearish divergence right now, so it is easily possible we get a further pushback up to a new all-time high, put in a third drive of bearish divergence, and then we see a big sell-off the same way that we saw 3 drives of bearish divergence, a lower high, and then a capitulation dump, 3 drives of bullish divergence, and then a massive move to the upside. I would expect a very similar thing as well, as the market makers tend to just do the same thing over and over again. But sometimes they mix it up, and we might not get that. So paying close attention, but we were obviously pointing out this bearish divergence right here and expecting a sell-off. The key levels, in my opinion, to watch are, can we close back above 62,300, or do we break down below? Because a daily close below 58,350 is going to look bad. as we would have taken out that previous high, low before we put in the previous high. So I'm paying close attention to it. But yeah, that's it for today, guys. Appreciate everybody checking us out. And I will see you on, I may do a stream tomorrow, a short one, where I look at stocks while the market is open and try some different times up, as I do have an international audience. But you can definitely expect me still on Sunday, and then probably a stream on like Friday or something like that, like a weekly wrap up. Maybe I'll deep dive into crypto then, going into the weekend, because we usually see a lot of volatility. I'm really just trying to look and see what I need to do to build the channel up a little bit, grow it a little bit, you know, give you guys what you want, give the potential new people out there what they want, etc. And that sounds like the overall consensus is less assets, less technical analysis, and shorter videos. So, you know, that's what I'm looking to do for you guys. But that's it for today. Appreciate everybody checking it out. And I will catch you guys on the next video or live stream. That is Crypto Trend Trader with our midweek market update. It is 11/17/2021 at 9:51 p.m. Eastern Standard Time. And I'm getting the fuck out of here.